Hello and welcome back to Bunnex Investment Group. In this video, I am going to show you one simple trading pattern that repeats over and over every week. For traders to make money, they should be good repeaters. But however, I come across a lot of traders who start the London session as trend traders. In mid-London, they become consolidation traders. In early US, they become reversal traders. And then as the day ends, they become random traders. So I am going to show you where to enter, where to exit, as well as how to analyze those particular entries. If you've seen my previous video, I actually talk about the qualities of a trading strategy, whereby you need signal generation method, confirmation and validation method, and then trade management method. If you do not have all those three things, it means that your edge is poor and you are likely to be losing money. Right, so the title of this video is one particular trading strategy that occurs over and over each and every week. So it's going to be very easy, and anyone who can follow will definitely make it out of this particular trading strategy. It's an edge that you can actually rely on because it is a consistent signal generation process, and then it is a validation and confirmation process, as well as trade parameters or trade management process. All right, so what we are going to require is basically the trader's dynamic index. It is the basis of this particular strategy, which is going to simplify how we are going to view entry points. Right. So before we talk about anything, I want to define the trader's dynamic index, which is a free indicator that I can provide you for free. Just say hi on Telegram, not in the comments, but on the Telegram channel, which I'll leave in the description box below. So basically, the trader's dynamic index is a common indicator which utilizes the volatility bands derived from Bollinger Bands, the RSI line, the one in green, the signal line, the one in red, then the full moving 50, the one in yellow. So whenever we see this RSI line going outside the bands, we call it a shark fin. And whenever a shark fin has been issued, it's actually a sign of market reversal. So our entries are going to be when we see this particular shark fin on the H4 time frame, it actually shows us a higher probability point of midweek reversal point. And from the midweek reversal point, our entries will be seen on the H1 time frame. So our entries on the H1 time frame will utilize the point of interest derived from the last candle in a particular trend. If the trend is upwards, the last candle of the upward trend, which is the last green candle, is the one that will give us a point of market interest. If the trend is actually a downwards, the last candle in that downward trend, which is a red candle, is the one that will give us the point of market interest. So let's now explain much more deeper so that we can understand. So this is odd against the JPY, which is Australian dollar against Japanese yen. And we can see that on the TDI, we had this point as a shark fin. So initially, let's start by marking the shark fin points, whereby the market went outside the bands and then it went back inside. We can see the green line, it actually went outside the volatility bands here. It also did the same thing here. Then we can see the same thing here, and then the last point here, which is on the H4 time frame. After that, on the H1 time frame, we can see the corresponding points are these ones. This was the first corresponding point to the shark fin. Then we can see this one being the second corresponding point to the shark fin, and then we had this one, and then the last one, which is this one. So after that, we've said the H4 is to give us this particular point of midweek reversal, where we would expect to see the market give us a reverse for a particular week. If we are on the H4 time frame, these black traces marks a period equivalent to a week. So if we now go to the H1 time frame, that is where we find the points of market interest. We've said the last candle in a trend we can see this was actually a downward trend to the downside, and then on that downward trend to the downside, the last candle was actually this one. And this is where we need to make an entry after the market actually, it's either it actually breaks out of that range and then retested that range, which is at this particular price point. So we've said the last candle, which is the red one, and we mark its high and its low, or its close and its opening, depending on your preference. And then we need to see price going outside and then retesting that particular zone. So it actually shifted outside that range, retested that zone, and the market went to the upside, basically like that. Then we can see we had that similar process that we've marked on the H4 time frame. We've said we need to mark the last candle of the trend. This was actually an upward trend. Therefore, we need to see the last green candle, which is this one. It's high and low. The market went outside of that range, and then it went back right in that particular range, where we can see a beautiful retest of that particular point of interest, and the market went our way. What is our trade management parameters? In this case, we've just talked about signal generation, which we've said signal generation is actually attained by H4 shark fin, H1 order block retest, and then our trade management will now require us to have points of market exit. Our exits should be at least at 60 to 100 pips, because this is actually a weekly range. 60 to 100 pips, or basically half of the weekly range. When by weekly range, we are saying if the market had gone to the upside, we can target to exit at half of that range. So we can see another point, and the last candle to the downside was this particular red candle. So marking it, the high and the low, we can actually have something like this, whereby the market went outside of this particular point of interest, retested it, and then it went to the upside like that. So when we've entered at this particular retest, we can hold it for half the weekly range like that. So this is how we will be actually generating our signals: signal generation, validation and confirmation, and then the trade management parameters in place. And with that, you just need to practice patience, because of course I can even give you a trading strategy that is 100% accurate, but if you are not practicing other areas of trading, you are not going to make money. And making money in trading will now come from your discipline to follow that particular trading strategy, no matter the losses or wins, and then being able to consistently calculate your risk each and every time you enter any trade. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.